So what is risk?
Let's start by understanding what is risk. We hear the word risk used in many different contexts, and in I think most common understanding of risk, or our intuitive understanding of risk, is about relating to danger of loss, or possibility of loss, which certainly it's one useful definition of risk. But for looking at the relationship between risk and return in scalable entrepreneurship, I want to use more of a financial definition of risk, which is the volatility of returns. So I think once we have a more specific understanding of what is risk for our purpose, we'll be able to understand better what is the relationship between risk and return. So with that understanding of what is risk, we can start looking at what is the relationship between risk and return. I think most people would have heard the expression, high risk, high return, low risk, low return. And this would summarize their understanding of what's the relationship between risk and return. These two phrases sound like they mean something very similar. So high risk, high return, low risk, low return. But do they really mean something very similar, or do they mean something very different? I think we can understand that better if we try to convert these two statements or transform these two statements into if-then statement. If-then statement is a statement in the form of if something, then something else. So if something is true, then something else always follows. So let's look at those two statements about risk and return transformed into if-then statements. Let's take the second one first. If I take low risk, then I will achieve low return. Is this true or false? At first, it sounds like this might be false because we believe we might be able to think of an example of a low risk, high return investment. Because if the statement of if I take low risk, I will receive low return is false, this means there must be a low risk investment that delivers other than low return. And let's rule out the case of no return. And therefore, if we want to say that the statement, if I take low risk, I will achieve low return is false, we should be able to come up with at least one example of a low risk investment that delivers a medium or high return. And I'm pretty sure that if we, no matter how much time we spend on that, we're not going to come up with an example, because I believe that there are no low risk, high return investments. There are only low risk, low return investments, and high risk, high return investments, and of course medium risk, medium return. Now, some of the exception cases that when I ask this question to large groups of people, some of the exception cases that usually come up are, well, what about lottery tickets? Aren't lottery tickets low risk, high return investments? Because I invest only a very small amount of money, but if I win, I can win a large amount of money. This is confusing the amount that is risked with the level of risk. Just because lottery tickets are inexpensive doesn't mean they're low risk. In fact, lottery tickets are extremely high risk for the buyer. They're so high risk that in effect the buyer is guaranteed to lose money on every lottery ticket. The expected value of the lottery ticket is negative. We know that this is true because we can look at the other side of the lottery game and see that lottery tickets are sold by government, who is basically guaranteed winner on every lottery ticket, meaning they are guaranteed that every time they run the lottery, they're going to make money, which means that on the other side, all the lottery ticket buyers are guaranteed losers. The same logic holds true in another example of low risk, high return investment that often people think of when I ask this question. What about in casinos? So if I play a game in a casino, I can just bet a little money and win a lot of money. You can see it's exactly the same dynamic as lottery tickets. Casino games are structured in such a way that the players will be net losers and the casino will be net winners. This is why casinos earn a million or millions of dollars a day, and gamblers lose so much money in casinos. You might think, but wait a minute, in my two examples, isn't government making a low-risk, high-return investment because they get to sell lottery tickets? It's true. Governments can create low-risk, high-return investments for themselves because they're governments. But low-risk, high-return investments are not accessible to ordinary investors in ordinary investment markets. And same thing with casinos, although they do they do get to play the other side of the casino game, in which case the odds are in their favor, but they are also subject as businesses to all the other risks of operating a casino or a casino resort in the hotel industry, and subject to competition by other casino resorts and also overall economic condition. So we can see that none of the examples that we come up with are going to give us low risk, high return investments. With one exception, one of my examples of possible low risk, high return investment is in high frequency trading, where certain arbitrage strategies can generate what appear to be risk-free returns, or very low risk return, but very low risk, high return for hedge funds or others that are using those strategies. However, when we look closely at that example, so high risk, high frequency trading returns, we can see that they persist. The opportunities that generate these returns only persist for extremely short periods of time. This illustrates the reality of low risk, high return investments. If they ever do appear, they disappear almost immediately. How can we understand that concept a little better? I would ask, how many people have ever found a $100 bill in the street? The answer is very few people have ever found a $100 bill in the street. I asked this question to thousands of people, and there's only a tiny handful that have ever found $100 bills. How many people find small coins in the street? Everybody finds small coins in the street. Why? What's the difference between finding small coins in the street and finding $100 bills in the street? When we find small coins in the street, this is a low risk, low return opportunity. If we ever find $100 bills in the street, it's a low risk, high return opportunity, which is why it doesn't happen. And why doesn't it happen? Because when $100 bills appear in the street, very infrequently, somebody else always finds them first, not you. That's how that illustrates how these low risk, high return opportunities, if they do appear, are erased almost immediately by market forces. Imagine that there's a company that we can measure the risk level. We can't really do it like this, but imagine we could measure the risk level of that company as risk level 5. All other companies in this market of risk level 5 are paying return 5, which is exactly commensurate with the risk. Now, imagine that our company starts paying return level 6. Why are they doing that? Now they're paying a higher return than they need to, given the risk in that investment. They're doing this because they have a short-term need for cash. When they get enough cash to satisfy that short-term need, they will reduce their return. This shows that the high degree of positive correlation between risk and return is driven by the supply and demand for capital. So when there's a mismatch between supply and demand for capital, the market will correct this relatively, in most cases, very quickly, so that the return on any investment will always reach an equilibrium level with the risk that the market perceives in that investment. So what conclusions can we draw from this? If we want to generate high returns, we have to take more risk. If we are not willing to take more risk, we must be satisfied with the level of return commensurate with that risk. This has extremely important implications for scalable entrepreneurs. Why? Investors who invest in scalable companies, meaning venture investors, are looking for high-risk investments. Why are they looking for high-risk investments? Because they're investing in these startup companies to increase their returns. Therefore, scalable entrepreneurs should be prepared to take a much higher level of risk than than the average person in the population, and even typical entrepreneurs. So, to make it even more clear, if I'm a venture capital investor and I'm listening to a pitch by a startup who tells me, I have great business idea, it's not risky at all, it's a sure thing. This is now, if I believe this entrepreneur, this is now not an interesting investment. Why? If it's a sure thing and there's no risk at all, then the return in this investment will not be high enough to exceed the hurdle rate in my investment making decision, and therefore not interested.